Thank you very much for having me here. So let's see if I can figure out how this works. Okay, so again, I'm Matt Kence, and I'm with Aberdeen Standard Investments, and I thought I'd start things off with a little bit of trivia. So the question I pose to you is, these three people, what do they have in common? So obviously the person on your right is myself. You've got LeBron in the middle, and then Steph Curry on the right. So any guesses? Nothing? Okay, so all three of us were born in Akron, Ohio, actually. So, if you think about what are the chances that, two people, two absolute greats were born in the same small city in the same era? It's pretty remarkable. And not even to mention that Steph Curry's pretty good at basketball too. He's an amazing three-point shooter. And see, my wife said that it wasn't gonna work. So what I thought I'd do today would be just kind of go through the high yield market, and then talk about where we've been, where we think we're headed, and how we're going to position the fund for that environment. So as way of further background, so I've been in high yield bonds for about 16 years now. I was initially with Standard Life. That was about 9 years ago, and obviously with the merger, it's now Aberdeen Standard. So I manage the ACP fund with Steve Logan and Ben Pakenham. They're located in Edinburgh and London as well. So, it's a very global portfolio management team. So what I thought I'd do then is just take you through, where the market's been. It's been a very eventful couple of quarters, as you probably know. So we reached the post-cycle tights of around 310 last October. And then immediately after that, you had the government shutdown, the Fed raising rates, oil dropped into the 40s, and then obviously concerns about trade, and we blew out to about 550, so pretty dramatic. What you can see then on the slide to your right is the flow data. So the flows have been very volatile. Throughout most of last year, you had a rotation out of high yield bond funds into loan funds. People wanted the floating rate exposure, obviously with the Fed raising rates. Now, fast forward to the first part of this year, and then with the Fed coming out and saying they're halting raising rates, China introduced more stimulus, and the ECB introduced some bank liquidity facilities. You had all that money come back in, so about 12 billion came back into the fund. Now, I should mention in terms of liquidity, it's been relatively tight. Last year was kind of a disaster, to be frank, in the market. At the end of the year, nobody wanted to take on risk, whether it be PMs, or obviously banks. Balance sheets of banks have been shrinking anyway, but you add in the additional volatility, and you add in the fact it's the end of the year, it was very difficult to buy or sell high yield bonds. In addition to that, you had very, very low issuance as well. So November and December were the lowest issuance months in 25 years in the market. So, you fast forward this year, you have a better backdrop in terms of the Fed, and you have all this money coming back in. You have portfolio managers that, haven't had any new issue to spend that cash on. Cash has been coming in the form of coupons, and you have this big technical rally. So really, I think it's safe to say is that this rally has been very technically driven, at least in our view. It's not your normal garden variety type of rally where the riskiest bonds are the ones that rally the most. It's actually been quite a bit different than that. So if you look at the chart on the top line is the spread of triple Cs, the bottom line is the spread of double Bs, and then that solid area is the difference between the two. Now normally when spreads are at this level, you see a good amount of compression between triple Cs and double Bs as people are chasing that risk. Well, that really hasn't happened in this market. That differential has stayed relatively wide. Now you look at the chart on the bottom, and that's investment grade. And what's interesting is a very similar phenomena occurred. The difference between triple Bs and single As remained relatively wide as well. And so it's not just the corporate credit market. You look at consumer lending, subprime, very hard to get subprime loans at that level, but higher quality borrowers, money was coming fairly easily. Look at the equity market. Lately, small cap has underperformed large cap. And what's interesting is since last summer, the best performing sector actually was utilities. So this is either a signal or for portfolio manager says there's an opportunity maybe for us to add risk in triple Cs. Oh, I hit the wrong button. So, what are we seeing in terms of fundamentals, and hopefully that'll get you to the answer of whether we think we should be chasing lower quality credits at this point. So as I mentioned, we did see a decent blowout in spreads, and then it rallied back, and then obviously with the trade war, it's widened again. But we reached this year tights of around 350, and now we're out to about 390. Putting that in perspective, historically, the average high yield spread is around 550. So in my view, that really isn't that wide, particularly when you then take into account the volatility we've had. There typically is a very good correlation or a component of volatility that goes into the spread, and we really haven't seen much of that at all. Now, talking about leverage, so leverage recently has actually come down in the US market, so we're at around 4 times. We were at close to 4.5 times. But keep in mind, this is really due to EBITDA growth. Companies aren't really paying down debt. On the European side, we're actually seeing leverage increase a bit here. Now, in terms of defaults have been very low, less than 2%. And our base case is that they'll remain there. And partially, some of that is just the benefit of the fact that the new issue market has been very active over the past few years. Companies have been very proactive in terming out maturities. So, a few years ago, there was this fear of a maturity wall hitting where you had a lot of the debt taken on in 2007, 2008 for LBOs was all coming due around the same time. And there was some questions, would the market be able to digest this, or would these companies in their current state be able to refi? So companies have been very proactive. They've pushed out a lot of those maturities, and they've done it at very low rates. So while leverage is relatively high, interest coverage remains fairly strong, actually. But I do think it's worth mentioning, it is late cycle. And as you know, the old idiom, cycles don't die of old age. The longer they go, the more pockets of risk can develop. So that's something just to keep in mind. I will say then, though, that our base case, again, is a sort of low growth environment, which could be very conducive for high yield. Obviously, if you get growth too high, the Fed will have to act. That'll raise rates. That'll impact total returns. If growth is too slow, then you get defaults, which obviously isn't good. But I think going forward, what we're, fairly sure of, you're going to see volatility. We're already pricing in a rate cut later this year. So if we get a reversal from that, you're going to have volatility. And then that's without even mentioning the trade issue with China. So this is a really interesting issue. And we've got economists globally, and they're very, very quick to mention that their confidence level on this is very, very low, which is understandable. What's interesting is, the actual direct effect of the tariffs is fairly quantifiable, and they think that's around 0.4% of GDP. That's the stuff that's relatively easy to measure. But then you have all the second order effects, the knock-on effects. So, business confidence, consumer confidence, things along those lines. The wealth effect as the stock market sells off, and that's unclear. So that could be another, 0.2, 0.3% on top of that. In line with their forecast, that still puts you in kind of a low 1% type range. Not robust, but an environment that we think actually most companies will be absolutely fine in. So before I move on and talk about how we're positioning the portfolio, I thought I'd just kind of give a plug for the structure of closed-end structure for high yield bonds. So what this here is the history of returns over the past few years since 1985 or so. And what you can see is there's really only been 6 periods of meaningful negative returns in that period. And each one of those was followed by a year of strong recovery, right? So as long as you don't crystallize those losses with defaults or being forced to sell, you can generate a very nice return and some good income. The other thing I'll mention in terms of the closed-end structure is the fact that as I mentioned, liquidity was tight in the fourth quarter. So, I also managed some open-ended funds, and so a lot of that time was spent in those funds. Instead of looking for ideas, I was having to sell. I was having to sell things at times I didn't want to sell, and at prices I definitely didn't want to sell at. Well, with this fund, I didn't have that problem. So that's obviously, a very huge advantage in that. The other thing I'd say is that we can capture a liquidity premium in portions of the market that do have less liquidity, whether it be geography or going into smaller issues, maybe a $250 million deal that we think is interesting because we know you're not going to need to be a forced seller at any point, as long as you get the credit right. And obviously, that's important. And then the last point I make just is the cash drag. So, if you have a high degree of cash because you're worried about outflows, and then you have a strong market like we've seen earlier part of this year, that can be 30 to 50 basis points right there. And, in a low yield environment, that's pretty meaningful. So, what do we do with this market? And I kind of alluded to before, we don't really feel like this is the environment to really be piling on the risk. So what we started doing, and if you look at the chart on the top, this is since the third quarter of last year, is we've been actually taking down the risk in the portfolio fairly meaningfully. So we've taken down triple Cs by about 10%. Now, that doesn't mean that we're avoiding triple Cs altogether. We are still looking for pockets of value. I'll give you an example. So surgery centers, which is an outsource, they do surgeries on an outsourced basis rather than doing it inside a hospital. So that's something much, much more cost effective. It's got good secular growth. It's more of an idiosyncratic risk. So you could argue, well, Medicare for all might have an impact there, but ultimately we think this is where the industry is headed. So there might be some volatility around that, but ultimately this is going to work. And it's a nice little company, a good yield, and so we put that in the portfolio. The other thing we did was, through the volatilities, we picked up some double B credits. So double Bs used to be almost nil in the portfolio. Now they're up to about 15%. So we got them at a good value, obviously good credits. And a couple of things we're doing in double Bs. So we'll take a credit such as GM, which is investment grade company, but we'll buy the bonds a little bit lower in the structure. So like a perp or something like that, so you get a little bit more yield. We're doing something similar with banks as well. So you've got a good solid institution, but you're just dipping down a little bit in the capital structure of that to get a little bit more yield. The other thing we've done then, and I kind of alluded to this, is move away from cyclical exposed credits into more idiosyncratic. So energy exposure. So we reduced that from around 20% to around 12%. Material bonds, metals and mining, that sort of thing, roughly have that as well. So, what else have we been doing? Well, as I mentioned, so my counterparts are in the UK, in London and Edinburgh, and then we also, as a global company, we've got 60-some people in Europe. We've got 18 people in Asia between Singapore and Hong Kong. So, what we're able to do is really bring all these ideas together and try to take advantage of them in this portfolio. So, whether it be a Moscow bank or an Indian metals and miner, we can look at those ideas. And what that does is gives us a lot of levers to pull. All cycles aren't the same. The US is coming off some stimulus, whereas Europe has been weak for a while. But, if the stimulus in China starts kicking in, the trade war, absent that, if that's behind us, then they should feel a little bit of an uptick in growth there. So you can kind of use that global opportunity set to find ideas across the board. On the chart on the bottom, though, what you can see is that over 50% of the portfolio exposure is actually in non-US domiciled bonds. So like the UK market, for example, and British pound denominated bonds, typically has a bit of a liquidity premium with that, because the high yield market there is relatively small. Well, what we can do there is, obviously in this fund, we don't have to worry about outflows. We can capture that liquidity premium. And in many cases, it's a company that is actually a US domiciled company. Like Netflix issues Euro bonds, we own those. AMC, the theater company, they actually issue bonds in pounds. So we're able to buy those. We get a spread pickup because of that. And what we do is we hedge that out. And what's interesting there is because you have this large differential in short-term interest rates between Europe and the US, we put on a forward contract because we don't want to take currency exposure. And then we're able to capture between 200 and 300 basis points of extra income then from that forward. So, you're picking up a meaningful amount of extra yield and income by doing that. So, it's kind of an interesting way to add some yield without adding a tremendous amount of additional credit risk. So I'd just say overall in this market, we really feel like the key is to avoid defaults. It's buying good credits, making sure you do the work. We spend so much time with our analysts just, it's the classic free cash flow walk. Show us EBITDA and show us how that results in cash flow. And then you stress it for, lower growth and just making sure these companies have the liquidity and have the cash flow to make it through. Because again, what kills the structure obviously would be defaults. That's really what you want to avoid. So overall, I'd say we have a cautiously constructive stance on the market. We have been reducing risk, but we've been increasing leverage a little bit on the margin. In terms of leverage, we decreased it below 30% last year, kind of ahead of the downturn, and we've been slowly increasing it back again above 30% since. But doing that in better quality credits and trying to offset the little bit less yield with a little bit more leverage on the margin. So that, I think overall, I think we're pretty confident though that we have the right team in place, that we have the levers that we can pull, and have the process to really continue to generate some good income for this fund going forward. And I thank you for that. And if you have any questions, Dan Buchanan, who will be, he has a booth out there. He'd be happy to take your questions. But I can take some questions now as well if people are interested. I guess on the way back on the aisle, please.
Yes, I wonder what your firm's view is of the likely duration and pervasiveness of the negative interest rate environment in Europe. And given the fact that you are anticipating a possible rate cut at least one time this year by our central bank, do you think there's any likelihood of a negative rate environment in this country?
So to repeat the question then, the question is the likelihood of a negative rate environment persisting? Yeah, so a lot of the world is already seeing negative rates. The one thing, there's obviously a lot of debate of, and I think it kind of goes along with that question is, the inversion of the yield curve and how meaningful is that? And, that's something that we definitely think, even if it isn't real, I think one thing I'd say is usually, according to that rule, a recession will follow. I think it's like, 9 to 12 months later. But even if it doesn't, there definitely is a psychological impact to it as well. So it does weigh on business confidence and such. I think in terms of rates, the US rates we do feel like will be continued to be dragged down by rates globally. There's only so much the US can do. There are some pretty massive dislocations that are already happening. The one I mentioned was what we can do on the hedging side. So it is something that's worth watching. But I'd say that's the advantage of being a global firm is that we're not pinned into any one particular geography. We can invest across the board and at different layers of the capital structure. Does that answer your question?
Yes, thank you.
Okay, great. Yes, sir.
I'm interested in the oil shale area, which of course there's been plenty of demand for people wanting to borrow there, but the reality has been that the economics haven't been what we were expecting because what they're finding and how long the wells can last has changed. How do you deal with that from the standpoint of what you have and how you change the characteristics in the portfolio based upon, I guess, an overview that wasn't as nice as it looked when people were initially trying to get as many funds?
Yes, so I think the question is, how do you deal with the fact that some of the E&P companies, in terms of shale, they haven't produced what everyone initially thought they would, right? And so how do you adjust the portfolio to that? And I would say in general, that's correct. Every time, you have, there's been a lot going on in the space actually. So what you've had is, you had management teams, to give you some background, historically equity returns were very much driven by growing production, right? And so managements then were compensated based on production growth. So, it wasn't profitability. The people weren't doing, long-term sort of math, IRRs on this stuff. Their incentive was to just keep drilling, drill baby drill. And so you kind of got what you got. And that kind of ended up in the bust in 2015 and 2016 as well. So now after that long-term, collapse in oil prices, tremendous amount of costs have been stripped from the system. Break-evens went from $70 or $80 a barrel to, on average, probably in the mid-50s, and with better areas, much lower than that. So, the question is, how do you invest? Well, I think the answer is, you can't throw out the baby with the bathwater. You've got to be extremely selective. There's certain areas that work and certain areas that are marginal, and you have to adjust the portfolio for the amount of risk that you want. right now, we're very conservative on that. So we're really focused on companies that are in the Permian Basin, companies that have a lot of levers to pull in terms of taking out costs. So many companies can get a decent return at, $40 oil, $45 oil. The marginal cost of oil is probably right now in the $55, $60 range. So, those companies can be okay. And then in terms of structurally, boards have changed the incentives of management teams. And along with that, or maybe because of, or probably the opposite really, is because equity investors now want free cash flow. So every time a company comes out and pushes out that free cash flow time frame, because as you probably know, these companies initially burn a tremendous amount of cash, right? And so it's really the companies that are able to actually generate cash now that our equity market is rewarding. So it's a long way of saying that you have to be careful. You have to know which acreage you're in. Management teams are extremely important. And make sure you understand what the break-evens are of the company and how the management is incented. So there are definitely some companies we like and some acreage areas that we like. So like I give you an example like Moss Creek, small company, but it's in the Permian, in a very attractive part of the Permian, next to some high-class, top-shelf type operators. So we have confidence in that one. Well, great. Again, I'll probably be around, and then Dan Buchanan is out there too, and he can help you with questions. So, thank you very much.